How's it going, everyone? In this video, I'm going to be discussing discount and premium pricing in your buy side and sell side liquidity and your structural ranges. Price will always move in terms of the following: creating lower lows, creating higher highs, and ultimately following where price is in the market and where financial institutions, banks, and large investors that pump millions and billions of dollars through the market every single day seek to collect orders and fulfill price at the cheapest price possible. And how the banks and financial institutions do this is collect orders in areas where price is cheaper at a discounted price rather than where it's more expensive, that we call premium areas of pricing. So in this example that I've drawn over here, we have a clear high and a clear low. Price pulls back after that previous break of structure, needing to collect orders in that previous structural range, whether that could be Asian liquidity, Frankfurt liquidity, London liquidity, New York session liquidity, which again we will discuss in further videos. Price will need to collect orders, sweep liquidity, whether that is areas of equal highs, trend line liquidity, or a support area where there is tons of stop loss orders for price to lie. And you will find banks and financial institutions will often collect these orders in the discounted areas of pricing in the structural range. So the easiest way to go and mark this is we'll have price moving with the following order flow: creating lower lows, pullbacks, collecting orders, filling areas of supply, collecting fuel in the market to target those exposed expectational weak lows. And the easiest way to mark out your discounted and premium areas of pricing is to either take your Gann box tool, which you can mark the top of the range, the bottom of the range, and the 50% of the range. You can also use your fib tool, which I've set to the following settings if you want to screenshot and save this: 0, 1.5, and I've set it to a transparent background with a light gray color, which marks out my 50%. Any orders lying below the 50% of that structural range is orders and liquidity that lies at a more expensive price that we call premium pricing. Any orders that lie above the 50% of that structural range, orders will be sitting at a cheaper price, which is what we call discounted areas of pricing. It's also important to note that price does not move in one range. There can be ranges within ranges. So for example, within this higher time frame leg, we will have lower time frame, structure busy forming, catering for that higher time frame pullback. And each and every one of these lower time frame legs also cater to be ranges. So again, we can mark out those highs to the lows, price creating those breaks of structures, that pullback collecting orders in discounted areas of pricing, expectational order flow to target those weak highs, price pulling back to mitigate price in discounted areas of pricing. We've now mitigated discounted areas of pricing in the higher time frame swing range, which we've now potentially mitigated areas of supply. So the expectational order flow is starting to look for price to target those weak lows, and we can expect price to have those lower time frame pullbacks into discounted areas of pricing to continue targeting those weak lows. And all of these structural ranges is price sweeping liquidity and fulfilling orders at the cheapest price possible. This would be a realistic visual example of price creating structural ranges within a higher time frame structural range. Towards the end of this bootcamp, we will do an entire live walkthrough breakdown and a live trading session pre-recorded to show you what it's like going into the live markets to identify these structural ranges. As price starts to mitigate the discounted areas of pricing, price reaches a higher probability of reversing on the lower time frame, starting to target those weak lows and create lower lows, which adds to the probability of us as traders getting on the right side of the markets and in the footprints of larger financial institutions and banks that are pumping money into the market. at the cheapest prices to ultimately get involved and ride on the right side of the market where all the money lies. In a bearish market, if you're looking to get short, you ideally want to start looking for shorts within the discounted areas of pricing. And if you want to look for longs in a bear market, you ideally want to look for longs in the premium areas of pricing to ride price into discounted areas of pricing. Okay, so let's go through a live example. On this pair, most recently, we have had a structural break of structure to the downside on the 4-hour time frame. We can mark out our discount and premium pricing with our fib tool from the high to that low after that pullback has started. And let's play price throughout. As price is now in premium areas, we can expect price to collect orders in the discounted areas of pricing. We do also have some liquidity and inducement sitting below, which is good probability for price to sweep that, fulfill orders in the discounted areas of pricing, perhaps in areas of supply, to continue targeting these expectational weak lows. So let's have a look as price follows through. If you want to be looking for longs, you want to be looking for longs in the premium areas of discount pricing. So if, for example, we wanted to target a 1-to-1 risk to reward, targeting the discounted areas of pricing, this is ideally how we want to be looking for buys. All right, so we've now mitigated discounted areas of pricing. What can we expect? Is price either to continue target these weak lows, these areas of supply potentially first, sweeping this liquidity before continuing to target those weak lows. So this also becomes valid buy side liquidity. Why is that so? Because we're sitting in discounted areas of pricing. We have a valid high time frame supply, which is good probability that price will sweep this, mitigate areas of supply to continue targeting these weak lows. Okay, let's follow through price, see what happens. Okay, there's the sweep of that liquidity, mitigation into that supply, and expectational order flow to now continue targeting these weak lows. So let's continue this through. We can now remove this discounted areas of pricing as we now have a new structural range. We've had this break of structure. We have a new strong protected high, a weak exposed low. We have a valid area of supply, and we can mark out our discounts and premium pricing. So again, expectational order flow is to mitigate discounted areas of pricing to mitigate areas of supply, and we want to see our valid buy-side liquidity form for the supply in order to get involved on shorts to target these weak lows. Let's play our price and see what happens. Okay, so we do have valid liquidity over here, which would be our valid buy side. So we could potentially see a sweep of that to continue targeting those weak lows. Okay, and there's an example where price did not mitigate discounted areas of pricing, but we still targeted those expectational weak lows. We can now update price. We've most recently had this new break of structure to the downside. This becomes our strong protected high. This becomes our new area of supply. And this can become our weak exposed low. We can mark out the discount and premium. So the expectation is to, ideally we want to see liquidity form, sweep that liquidity into the discount, into areas of supply to continue targeting these weak exposed lows. Let's continue price and see what happens. Okay, and a new break of structure to the downside. New strong protected highs. New area of supply. Weak exposed lows. And we can mark out our discounted and premium areas of pricing. Okay, mitigation of the discount mitigation into the supply to continue targeting those weak lows. All right, here's a good example of where we swept liquidity, mitigation of supply. We actually swept the supply as well. We produced a displacement with a fair value gap entry to continue targeting those expectational weak lows. All right, so new break of structure to the downside. We have created a new strong structural high, new areas of supply here, and we also have a valid second supply zone over here and our weak exposed lows. This low will become our official weak low once price takes out these internal weak highs. Okay, so that can now become labeled as our weak low. We can also mark out our discount and premium. So we're still in premium areas, mitigation of discount. We have formed valid buy-side liquidity. So what can we expect is a sweep of this liquidity into these supplies to continue targeting these weak lows. So have a look what happens. Sweep of the liquidity again into the more extreme supply. All right, price still busy sweeping these supplies. If we get the candle body closure above this high, then our expectational order flow shifts bullish. There's that candle body closure. So now all that changes, supply has now failed. Demand now comes into control. So we have new strong protected lows, the break of structure to the upside. These become weak exposed highs. So the expectational order flow is now to continue targeting these weak highs. If we mark out our discount and premium areas of pricing from that new high to the low, we have premium, discount. The probability of price mitigating demand areas in the discounted areas of pricing is good probability before continuing to target those weak highs. We have valid demand at an extreme and a more recent demand zone over here. Okay, we also have a valid demand area here, but is this as good probability as the more extreme demand? No, because these demand levels have valid sell side liquidity sitting above, so therefore this demand zone would be trading amongst liquidity. So let's continue through price and see what happens. Keep in mind the expectational order flow is to pull back into discounted areas of pricing before continuing to target those weak highs. Okay, pullback, we've mitigated discounted areas of pricing. We have formed more liquidity over here, so this is valid sell side liquidity to sweep, mitigate areas of demand. Okay, and we've now had this market structure shift with a valid order block over here, with a valid order block and a more extreme order block over here. So we could see a potential sweep of this liquidity, because this is valid sell side liquidity sitting above a demand zone, to continue higher. Let's see what happens. Okay, sweep of that liquidity to continue targeting those weak highs. Break of structure. What can we expect is the pullback into discounted areas of pricing, which we've just mitigated, to continue higher. Okay, so this is where Euro USD is currently sitting. The expectational order flow after mitigating discounted areas of pricing in this internal structural range to ultimately target the overall swing structural weak highs. Over here as well on this previous structural range, that break of structure, that pullback into discount to continue targeting those weak highs. New structural range, that pullback into discounted areas of pricing for the expectation to now continue targeting those weak highs. That break of structure, that pullback into discounted areas of pricing to continue targeting those weak highs and the overall swing weak highs. My homework and task for you at the end of the video is to do some practice yourself. I would like you to come back all the way to the beginning of June 2023, mark out your 4-hour structural ranges, mark out your discounts and premium, and watch as price mitigates those discounted areas of pricing to continue targeting those weak highs. Okay, so if I had to do an example for you, starting at the beginning of June, structural break of structure, pullback into discounted areas of pricing to target those weak highs. New break of structure to the upside with the new week low, price pulls back, does not mitigate the discounted areas of pricing, and we eventually target those weak highs. Okay, new structural high to that week low, price mitigates discounted areas of pricing to target that weak high. New structural high, structural low, pullback into discounted areas of pricing to mitigate and target that weak high. New structural high, new structural low, pullback into discounted areas of pricing and demand level to continue targeting those weak highs. New structural high, this would be our new structural low, mitigation into demand, price never continued to target those weak highs, instead we broke structure to the downside. But keep in mind, within this entire swing range, we also have internal structure. Okay, break of structure to the downside, pull back into discounted areas of pricing. Break of structure to the downside, pull back, just wicked into discounted areas of pricing to target those weak lows. New structural high, new weak lows, pull back into discounted areas of pricing to target those weak lows. Okay, new structural high, new weak low, pull back into discounted areas of pricing. Over here, we just had wicks. We didn't have that candle body closure, so therefore this was just a sweep to continue targeting those weak lows. Okay, new structural low, structural high, pull back into discounted areas of pricing to target those weak lows. And I just want you to keep practicing this and following it through yourself to start seeing it on the live charts. Take care, guys, and I'll see you in the next part of this bootcamp.